Hello, this is Jordan. This video is being recorded on Monday afternoon, June 6, 2022. Thank you so much for joining me today. In this video, I'm going to talk about an indicator that we can watch for gold. Now, a little clickbait in the title because this isn't that original, but let me get right into it. So this indicator is the 2-year yield, which is a proxy for the Fed funds rate. And the reason why watching the 2-year yield is important is because it tends to lead the Fed funds rate. In other words, the Fed follows the market. The Fed follows the 2-year yield. And what I want to discuss here is how gold has performed recently during this period of Fed rate hikes, but also during this period of the 2-year yield rebounding quite aggressively. And I want to compare that to other times recently in the last 20 years or so. Now, the first thing to point out, the blue vertical lines, they show peaks in the 2-year yield. And so you can see that gold it's performed really well when the 2-year yield has declined significantly. So in other words, we know that gold has performed really well after the Fed, or when the Fed has started cutting interest rates. We saw that at the 2001 bottom in gold. We saw that the middle of 2007, kind of in the beginning of the financial crisis when they had to cut rates there, I think in August, and then gold took off. It broke out, before the 30% decline. We see that if we look at 2009, 2010, there were peaks in the 2-year yield, and then it plunged there from early 2010 down to August 2011. And you see gold, that was gold's final run, you could say. And so, during the period of rate hikes in the mid 2000s, gold performed pretty well. I mean, it had that huge breakout in 2005. I think it was mostly due to inflation expectations were really rising. Then after oil had broken out and was outperforming, the industrial metals were really hot. You had all the demand from China. So it wasn't a real rates story during that period. And that was essentially, you have that period and you have the 70s when gold was rising during a rising Fed funds rate and rising 2-year yield. But, more recently, we can see that the end of 2015 to end of 2018, those rate hikes, gold basically went sideways. Its two lows were at the end of 2015 and then at the end of 2016. You could kind of call that the dual beginning of the Fed rate hike cycle, and those were gold's two bottoms. So gold bottomed when the Fed started hiking. And, I was talking about that at the beginning of this year. That's what I was expecting. It didn't really work out that way. However, we know that the Fed has been way behind the curve. They should have, if we look at how much aggressively the 2-year yield had been rising, the Fed should have already been hiking rates in 21. And so we can see that the low in gold basically coincided with the low in the 2-year yield. So since then, gold has been consolidating in a very large sense. You could say it's a bullish consolidation, even though it's, for the most part, hasn't been able to stay above the long-term moving averages. But that is, that's similar to what happened in the, we could say in the 2016 to 2018 correction period, where short-term yields were rising strongly and gold held up pretty well. It didn't break down, although, the stocks and silver really underperformed during that period. And look, we've seen the same thing again this time around. So, the question is, are we moving into a new era where the Fed isn't going to be able to cut rates? I don't see that happening. I think there's various scenarios, but if you look in the mid 70s, even when inflation was really high, the Fed, during that recession, the Fed started cutting rates 4 months before the inflation rate peaked. And of course it was going down. So I mean, in this period, if the Fed thinks inflation is coming down and the reality is everybody's convinced we're going into a recession, the Fed's going to have to cut rates. Inflation will be coming down, so it doesn't matter if it's 6%, 5%, 3 or 4%. And that, to me, I mean, I've talked about it before, but that would be the really bullish catalyst that gets gold breaking out of, making that major breakout that we've all been waiting for. And so I've also talked about the 10-year yield, but, we could see, at least over the next few months, we have this potential bear market rally in the S&P. Bond yields could be rising in the short term. There could be tough talk from the Fed because of these reasons. And also because of oil, looks like it's breaking out. Maybe oil will run to 150. So even though the economy is getting weaker and is probably approaching a recession, the story over the next few months, it might still be an inflation story. And so, but at the same time, oil breaking out, inflation remaining persistent for a couple months, that's going to be bad for the economy, and it's going to that type of situation is going to even put more pressure on the economy, potentially going into recession. And so I'm just saying, potentially over the next month or two, the idea that the Fed's going to cut rates, probably it's going to look stupid. However, at some point, the move up in oil to 145 or 150, you get this hot inflation staying around for a couple more months. When the narrative flips and when the worry becomes growth and recession, it doesn't matter where inflation's at. At that point, the Fed is going to cut rates. And that's why watching the 2-year yield is really, really important, because I think, later this year at some point, whether it's, middle summer, end of summer, fall, when that turns lower and the fear is more so, it moves from the fear about inflation, it moves to, okay, we're worried about recession and growth now. That's when the Fed does a 180. It's really interesting to look at Fed policy, because they're going to want to get these rate hikes in, but as soon as the narrative and the worry flips to recession and growth, the Fed's going to do a 180. And that's also why they want to get these 50-point hikes in June and July, and then maybe even hike in September, so then they have a lot of room to cut when inflation is coming down and the fear is recession. So I know that's a lot to take in here, but that's how I see the situation, the macro situation, and with respect to the 2-year yield in gold. So you could see over the next month or two, you could see bond yields rising, but that could be a false signal in a bigger sense. And so again, I think this could be the next catalyst for gold, is the Fed, the economy turning lower. Everyone's worried about recession more so than inflation. Then the Fed's going to have to do a 180 and cut rates. And that's when you're going to see gold breaking out. And so I sketched in, look, gold can even come down to, I don't know what that is, 1750. It can even test, 1715 or 1720, the 40-month moving average. And it can rebound from there and still be in a really bullish consolidation. Excuse me. So, the larger technical pattern that gold is in, that's still really bullish. Bottom line is, if you tell me the Fed's going to be cutting rates at some point, I'm going to tell you, okay, that's when gold is going to break out, when the Fed's cutting rates. Let me know what you think in the comments. Really appreciate you watching, and I'll have another video for you guys in the days ahead. Thanks.